Now, if you check out news headlines, you'll see China tech crackdown is ending. This was first reported on Wall Street Journal, and many tabloids have since picked it up. If you look for details, you'll see that Vice Premier Liu He has repeatedly pledged to support private companies, and he has signaled an end to the period of regulatory scrutiny that has impacted many big tech Chinese firms. Vice Premier Liu He is obviously President Xi Jinping's closest economic advisor, and he's been tasked with maneuvering the economy away from this deep slump by the zero COVID policy. But also to note that CAC did not specify to companies that they have concluded on investigations. It is just purely, as of this moment, market intelligence or market rumor. Now in this whole discussion, I'll share with you my thoughts, and if you stay to the end, I'll share with you a glimpse of what I have been doing. So if you're keen, continue watching on. Hi guys, welcome back. Before we dive into my point of view, let me show you some charts. The first one is this, which compares Alibaba against KWEB, which is a very popular Chinese tech ETF, against CQQQ, which is also another very popular Chinese tech ETF, and last but not least, against QQQ, which represents Nasdaq. They've all been in a downturn, but Chinese tech in general has been in a downturn since February 2021. But if you scrutinize clearly, you realize that Alibaba, which is the dark blue line, has actually been in a downturn since October 2020, which is more than 1.5 years ago. Now, a second quick finding from this chart is that you realize that KWEB has performed even worse than Alibaba, even though it is diversified. If you dive into KWEB, you realize that Alibaba is only its second biggest holding. And since Tencent, Meituan and JD.com have done relatively better than Alibaba, I'm quite surprised to see such a diversified ETF doing even worse than Alibaba as a single stock itself. The third thing to realize is that CQQQ has fared much better than KWEB. And one key reason is that it does not have any Alibaba exposure. In its top holdings, you see Meituan and Tencent, and this ETF gives you a diversified approach. The fourth observation is that QQQ, which represents the Nasdaq, has only made a downturn in November 2021. That was 6 months ago. And this is quite clearly not in the same phase as Chinese tech, because Chinese tech has been mired in regulatory risk, in negative sentiment, in slowdown in Chinese economy, etc. etc. But if you scrutinize for the last 1 month, you realize that Chinese tech has actually outperformed QQQ massively. So again, moving forward, I believe these two may not be in the same phase. With that iron out of the way, let me share with you my thoughts on this whole Chinese tech crackdown is ending theory. I've always shared on this channel, I approach the market assuming that the market is right most of the time, but only in extremes are they wrong. And quite clearly right now in Chinese tech, the sentiment is extremely negative. It is almost irrational already. So news like Alibaba's cloud service is now profitable is actually not so important in such an extreme climate, because that is rational performance when we evaluate a company. It's a bit like during the time of global financial crisis. Back then, Singapore banks, which are largely still profitable, as you can see in the charts over here, there were always concerns that Singapore banks would still get impacted by what's going on in US and European banks. UOB shares, for example, dropped from $23 all the way to $8 plus, and there was simply no rational reason to think that everything would be over soon. Most of the time, it's best to ignore noise, and in bear markets, people are grasping for reasons why there's a rebound. And this whole theory of the easing of crackdown really scares the hell out of bears. And I have something interesting to show you. On 15 March 2022, JPMorgan actually mentioned that Chinese tech is uninvestable. That caused share prices of Chinese big tech to plunge massively on those few days. Increasingly, that looks like the absolute bottom, and with each passing week, that solidifies that theory. Curiously, on May 11, JPMorgan has mentioned that this investable term was actually a mistake on their part. And right now in June 7, you realize that they are echoing what is mentioned on the market, that Chinese tech seems to be on the verge of a turnaround, and that Chinese equities are at a turning point whereby there's easing of lockdowns, and that there's credibility to reports that China is ending its regulatory crackdown on Chinese tech. If you plot such noise on a chart, you realize that JPMorgan was the one who first called uninvestable. That was in March. When markets dipped back again and couldn't crack the absolute bottom, they flipped around and said that it could be a mistake. And right now, they are saying that it's on the verge of a turnaround. For me at this phase for the Chinese tech market, it's quite obvious. Operational performance are not that important because valuations are cheap, but people are still debating about the risk. What about for noise? While now it sounds great that this is good news, market noise is also fickle. So more important is to battle your own emotions in this bear market. If we pull up the chart for market psychology, realize that in this rally, there'll be people who are going to believe that this is a sucker's rally. This rally will fail like many others. And if you don't believe, check out the comment sections. I'm sure there'll be a lot who will justify that they will still not invest in Chinese tech. The harder part is to really understand that markets eventually will recover, and that after previous losses, the fear of losing more money outweighs all else. We could even argue that now seems to be a phase of uncertainty, whereby the herd hesitates and misses the optimal window to enter the market. Now this is clearly a different phase from US tech. Most are saying that US tech are solid companies, are great companies, they will come back. There is no denial, there's no depression, there's also no anger at this market psychology. And that's why I've generally disagreed calling the end of this US tech bear market. So with that iron out of the way, let me show you what I've been doing as what I promised at the start of this video. I've kept my 2 Chinese portfolios. The first is this 2,000 per week for 10 weeks. It has fired and completed its firing as of 18th of March 2022. Now in hindsight, this seems to have hit about the bottom of the Chinese tech market. And right now, it stands at a minus 6%. Ignore the time-weighted return because that factors in the duration of the portfolio. The original dollar cost average I've done was actually 1,000 for 50 weeks. The plan was to do for the entire 2022 and I've stuck to it. Something that I've echoed as very important, especially if you're a new investor, to stick to your plan. And because the portfolio has been buying $1,000 every week for the last few weeks when market has been low, you realize that it stands at only minus 1.5% to break even. And as of this time you are watching, it's probably actually positive already. So a key message is stick to a plan, stick to an asset class which is generally cheap, avoid the noise and survive. And on top of that, I've actually made further moves. I mentioned before that Alibaba may be my pick as the outperformer within Chinese tech sector simply because it's depreciated the most in terms of value and they've committed to big share repurchases. You know, in stock prices for the short term, it's all about supply and demand. In the first 3 quarters of fiscal 2022 for Alibaba, it's repurchased $8.8 billion worth of shares. And this is a portion of its total ammunition to fire $25 billion in terms of share repurchases. If you see the impact on the outstanding Alibaba shares, you realize that it has dropped by quite a bit. And quite obviously, Alibaba is still issuing share options to its key employees. If you compare the magnitude of Alibaba's share repurchase against Tencent, it's Amazon.com which has done a recent share split. You also realize that it's pretty impactful because Amazon's outstanding shares have not declined even with share repurchases. And that's why on my trading platform, I've actually executed to purchase Alibaba shares, as you can see in this screenshot over here. I've actually started purchasing from 31st of May. This is done with the webull platform. They are pretty competitive, and right now they have actually a promotion which is free $60 worth of Apple shares with 2,000 deposited and 1 trade done. So if you're also keen to sign up for webull's platform, check out my referral links below and invest safe as always. Now if this whole discussion has benefited you, smash the like button, and in a subsequent video I'll be sharing with you 8 mistakes that investors make when it comes to bear markets. If you're keen for the topic, smash on the subscribe, and hopefully it has some investment wisdom that can benefit you in your journey. Thank you for watching till here. Check out some of my previous tutorials and I'll sign off from here. Take care and goodbye.